Hello, everyone, and welcome back to our Nonprofit Auditor Points. I'm Irina Ryshkova, your nonprofit auditor, and we continue our series for the questions regarding Form 990. In the last two episodes, I talked about the governance, and the questions we answer first, who is in charge of the organization, and then how governance policies and disclosure practices are presented in a Part 6 of Form 990. Today we're moving into another area of Form 990 and that often creates discomfort and confusion and even some tension inside nonprofit organizations. And that relates to compensation reporting, primarily which can be found in a Part 7 of Form 990 and in some cases in Schedule J. Let's talk about it. This episode is not about how to calculate compensation or how to prepare the Form 990. This is role for your accountants and CPA and tax preparers. This episode is for board members and executive directors and senior leadership to help them to understand what is reported, why is it reported, and how that information is interpreted by the public. The first and foremost, we need to understand compensation reporting on the Form 990 is a public information and it's not optional. Once the return is filed, names and compensation amounts reported in a Part 7 become available to everyone who wants to look. Donors, funders, journalists, competitors, and general public all have access to this information. For some individuals, especially those that come from private sectors, this level of transparency might feel very uncomfortable. However, this is a condition for operating in the nonprofit sector. If the personal compensation meets a reporting threshold, disclosure is required. It's not optional, and there is nothing can be done about it. Part 7 of Form 990 is where the organization reports compensation for a certain individuals. Without going into detail, this section typically includes officers, directors, key employees, and in some cases, the 5 highest compensated employees who are not officers, directors, and key employees. Let's refresh our memories. Key employees generally refer to individuals with reportable compensation over $150,000 based on the IRS definition. In addition, Form 990 may require reporting up to 5 other highly compensated employees if their reportable compensation exceeds $100,000, even if they are not part of the management or governance. That's also very important to understand. Which individuals belong in a Part 7 is determined by the IRS rules and is typically handled by your tax preparer or CPA. For non-accountants readers, the more important issue is not who qualifies, but what happens when somebody does qualify. If individual appears in a Part 7, their name, total compensation are disclosed publicly. If their compensation exceeds certain threshold, additional disclosures might be required. And then, if such situation takes place, it needs to be done on a Schedule J. Schedule J provides more detailed breakdown of the compensation. It includes base salary, bonuses or incentive compensation, other reportable compensation, retirement contributions, health, and other benefits. This level of details is required once specific threshold is met and commonly when compensation exceeds $150,000. It's very important for the organization leaders to understand that this information will be presented publicly in a Form 990. Again, this reporting is not optional, and even if the individual is uncomfortable with the disclosure, the organization must report compensation accurately and completely. Again, not optional. Now, there is one of the most confusing aspects of Form 990's compensation reporting, especially for the organization that do not operate on a calendar year. Even if the organization files Form 990 on a fiscal year basis, for example, year end June or October or May or November, any month but December, so it's not calendar year, it's a fiscal year end, compensation reported always on a calendar year basis in a Part 7 of Form 990. Again, regardless of the year end of the organization, reportable compensation, it's always on a calendar year end basis. This creates a lot of confusion and maybe additional calculation. For example, the organization may have a fiscal year that runs July through June. It files its Form 990 for fiscal year. However, Part 7 does not report compensation paid during the fiscal year. It actually reports compensation paid on a calendar year and within the fiscal year. Important, calendar year that falls within the fiscal year. So let's imagine an organization with a July through June fiscal year that hires an executive director in January. The executive director is an officer of the organization and is paid compensation. However, when Form 990 is filed, Part 7 may show that individual as an officer with zero compensation. To someone who is reading Form 990, it looks obviously incorrect. There is an executive director and there is a compensation to be paid, but the explanation lies in the reporting period, because in the reporting period, there were no compensation to that executive director. The executive director was hired after the calendar year in January, and there was no reportable compensation during the calendar year. That compensation paid during the fiscal year will appear in the next year, Form 990. And this rule exists for a reason. Why, you might ask? All employment-related IRS filing, such as Form W-2, 941s, and other payroll reports, they all on a calendar year. Reporting compensation on a calendar year basis allows the IRS match the amounts reported in the Form 990 with other payroll filings and creates additional layer of oversight and consistency for the IRS, but it might create extra confusion and extra work for nonprofit organizations. So this approach makes a lot of sense for tax administration purposes, but it creates confusion for the Form 990's readers that are not familiar with such rules. Board members, donors, journalists may assume that compensation is missing or understated when in fact it's simply reported in a different period, which actually correct way to present in accordance with the IRS rule. This is one of the reasons why this episode focuses on understanding, not mechanics. Leaderships of the nonprofits should be aware that these timing differences exist and be prepared to explain them if the question arises. Hopefully this information is useful for executive directors, to members of the nonprofits who does grant writing and talking to the donors and foundations that support nonprofit. Another important point is that Form 990 compensation figures may not watch a simple salary numbers. Reported amounts can include taxable benefits, deferred compensation, amount earned in the prior years, but reported in the current year. For that reason, board members and executive directors should review Part 7 and Schedule J very carefully before Form 990 is filed. To summarize, compensation transparency is one of the trade-offs of operating in a nonprofit sector. It supports accountability, public trusts, but also require organization to be thoughtful, consistent, and prepared. And it also might make some nonprofit employees uncomfortable. Therefore, it's important for the nonprofit leadership understand the transparency requirements and communicate it properly to employees. In the next episode, we will move into another area of 990 that often surprises nonprofit leaders, which is public support test and Schedule A. For now, the key takeaway from this episode: compensation reporting on a Form 990 is a public and calendar-based, detailed, very detailed, and not optional. Understanding what is reported, when it is reported, and why it's reported may help nonprofit leaders to understand and manage transparency and maintain trust of supporters of nonprofits. Thank you so much. Looking forward to see you for the next episode. Thank you. Be safe.